All right, what the heck happened just now to the stock of Domino's Pizza? On a day where nearly everything screamed higher, the stock plunged more than $13, or nearly 5%, in the wake of what was widely viewed as a mixed quarter. Now, Domino's has been one of the greatest growth stories in the restaurant industry, if not the whole world. Between the company's fabulous technology for online ordering and its rapid international expansion, there's been a lot to like here. But the numbers we got this morning weren't as good as we were looking for. Hey, they weren't perfect, and maybe that's the problem. While Domino's delivered a monster 20-cent earnings beat off a $1.75 basis, the revenues came in a tad light. As for the same-store sales, that's our key metric. The domestic numbers came in at 6.3%. Some analysts were looking for 7%, even as international numbers were in line, up 3.3%. And that's why the stock got slammed today. So we got to ask ourselves, is it merely a temporary blip, a buyable one? Or maybe we need to be a little more concerned. Let's take a close look with Ritch Allison, the new CEO of Domino's Pizza, to learn more about the quarter and where the company's headed. Mr. Allison, welcome back to Mad Money.
Hi, Jim. Thanks for having me back.
Okay, Rich, sometimes I wonder, because I read your release, I was on the conference call. You're doing so much better than everybody else. But at the same time, the expectations, because of the performance your company has delivered, are so high that I have to say to myself, well, you only did 6.3% domestic. I was looking for 7. What's with that shortfall when 6.3 is pretty darn good? So maybe you can put it in a context for our retail investors who are not looking at some spreadsheet.
Yeah, Jim, we were really happy with the quarter. If you start with retail sales growth, on constant currency terms, we were up more than 10%, feeling great about the growth of the brand overall. And in the U.S. specifically on the comps, we were very happy with 6.3%. That was rolling over an 8.4 from the third quarter a year ago. So I have to say, we're really happy with the results.
Now, if we want to take a look, here's something that BTIG pointed out. Operating margin decreased 130 basis points to 16.8%. Lower company store and supply chain margins partially offset by some of your costs. Now, what company store margins decreased 160 basis points. Are these numbers that I should be concerned about? Anytime we get any sort of margin compression, I'm always a bit concerned.
Yeah, Jim, we're not concerned about any long-term structural issues around the margins. Certainly, there are labor costs and other pressures out there in the marketplace, but we feel very good about the overall profitability, most importantly at the store level, where the cash-on-cash returns remain very strong, and then, of course, at the company level overall also.
Right. Now, I was concerned about labor costs, but I thought that maybe the best metric to look at was number of stores open versus closed. Why would you open a store if you were so constrained by labor?
Absolutely right, Jim. The best measure of the health of the brand is that our franchisees choosing to put their capital into Domino's Pizza. And what we saw over the course of the quarter and frankly throughout the course of the year is very strong unit openings and a very low number of closures. We've closed in the U.S. only 7 stores through the first 3 quarters of this year, which I think makes a remarkable statement, about the profitability of the business and also about the commitment of our franchisees.
I also want you to speak to the cash flow here because the analysts may be unhappy about some 0.5 this or that, but it's 6% comp store sales. Your company's making a ton of money, right?
Yeah, great cash flow, great stable cash flow through the business, Jim, and on both the international side of the business and on the domestic side of the business. So, yes, we're very happy with the results there.
Okay, now, because I'm so closely identified with Domino's, I put on Twitter, I said, does anybody have any questions? Of course, there's always wise guys who say, can I have double cheese? But Pat Brisky asked a question I thought was interesting. He goes, how does Domino's plan on capitalizing on Papa John's woes? And I know it was addressed somewhat in the call, but I'll put it to you from what my Twitter file says.
Sure, Jim, it's a really fragmented category. As you know, we're the market share leader in pizza, but we still only sell about 1 out of every 6 pizzas in the U.S. So we're staying focused on our strategy and our execution and not really on the short-term ups and downs of any one particular competitor. If we stay focused on the things that we've been doing, then we're going to continue to take share from competitors, small and large, across the industry.
But I would say that if we were talking about, let's say this was Amazon and we're talking pizza, I would say technologically you continue to pull ahead. I think the Hotspot ads were terrific. How did Hotspot do for the summer?
You know, it was terrific, Jim. You know, it's just another great way that we're engaging our customers. You know, a lot of restaurant players and a lot of players in pizza, you know, are constant members in the Product of the Month Club. And we got out of that club a long time ago and started focusing on things that were interesting and innovative that we could do to engage our customers. Hotspots is another one of those. Shows our customers we're so crazy about pizza, we're going to take their pizza to them anytime, any place they want to get it.
Now, there are some costs that are coming down. I'm conscious of the fact that because I follow the paper industry very closely and corrugated is coming down because there's excellent, more capacity coming on. Not every single food item is going up in price. Are you guys able to handle the inflationary pressures okay?
Yes, you know, we're still very much within our expected range, you know, in terms of cost increases over the course of the year. You know, what we have been saying is in that 2 to 4% range, and we're still very much in that range. So we feel good about how we're managing those costs, and most importantly, you know, feel good on a continued basis about the margins and the returns for our franchisees.
Is there anything else that you can do in automation short of autonomous vehicles that you're cooking up, or is that just asking for too much to give us so much money?
You know, we're working on a lot of things, Jim. You know, autonomous vehicles are certainly one thing that we've been working on. We've talked to you in the past about DOM, our artificial intelligence natural voice system. We're still piloting that in some of our corporate stores. It's learning, it's growing, it's getting better. You know, and we announced on the call this morning, we just recently rolled out within our stores a voice inventory app that our team members can use for one of the most unpleasant tasks they have, which is at the end of a shift, they've got to go count the food that we have in the walk-in cooler. And this makes that job easier and faster for them.
Well, terrific. I think that to call this a miss is just the kind of thing that Wall Street does. Main Street knows when there's an opportunity. Thank you so much to Ritch Allison. He's the CEO of Domino's Pizza. Another good quarter. Thank you so much, sir.
Thanks, Jim.
Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.